Hey everyone, welcome back to my channel. So today I wanted to talk about day trading. Day trading, first and foremost, is an actual profession. It's a job given to those who are believed to be experts in that field and industry in order to trade millions and millions of collateral and assets every single day. The average day trader earns an income of $56 an hour. Meanwhile, the bottom 10% make under $68,000 per year. Now, day trading is essentially the ability to buy a stock, buy a business, buy a percentage of a company, and then still trade it within that same day. That may mean doing an options trade to the point where the stock goes down and you bet on it going down or up, or the stock goes up and you bet on it going down or up. That can also mean purchasing the actual stock, whether it be Facebook, Apple, or whatever, and it going down or up a percentage and you selling for that profit or loss. So day trading doesn't necessarily mean you make money doing it, right? You might buy a stock, expect it to go up, and you want to sell that same day because of news pertaining to that company. But it goes down, and now you've lost money. Or you may buy a stock, and you just believe in it a lot, but you don't see it as a long-term play, and therefore you buy it with the desire to sell it within the hour, 2 hours, or within the trading market. Another thing is, if you see a stock that is heavily discounted, you may see an opportunity to buy low and then sell for a little bit of a premium when it starts to go up, because you know it's at its bottom floor and you know that the stock is with a good company, and therefore you should see some gains and some increase. For example, you may see a company like Google that has dropped for a very insignificant reason. Maybe there was something to do with other companies, other markets that caused people to sell off for that entire day. And you understand that Google did absolutely nothing to be a part of that. And so if Google dropped 10% when a normal drop is 5%, you can assume that it will probably go up at least 5% to get back to its normal levels. And so you would probably put in money in Google, assuming that is going to go up. And again, that is not a strategy or financial advice that you should follow. I'm just an average YouTuber giving you some information to do your own research and fact check all of these things. Now, something personal was I had a lot of friends who day traded, especially penny stocks. And what is typical is that when you have people who are just starting out, they don't necessarily have the money or the resources to allocate towards bigger, more profitable companies, more established businesses. And therefore, they're going to look for bottom feeder companies that are barely on the stock market exchange. And they are going to purchase these companies with the idea that if I purchase 100 companies with 100 pennies, one of them is going to go to $1, and now I'm going to 100x my money, right? So a lot of people have the idea, if I put $100 into 10 penny stocks and it goes up to $1, I'm going to make $10,000 or something like that. So, and then is it a strategy? Sure, you can call it a strategy, but ultimately it's really a gamble. You're gambling on 10 companies that are probably going to fail, on whether or not it's going to be hyped up enough or actually create a value to where it is justified being worth $1 or more, right? So again, there's really two ways that a company that is not profitable will earn you an income. Is either it was hyped up for a pump and dump, or they actually increase their value by doing things to show profitability, by doing things to show innovation and things that people can back or want to back, right? Now, what is a pump and dump, since I just brought it up casually? A pump and dump is basically pumping up a company, whether good or bad, for whatever reason. You want to pump that company up, and then you want to suck all the money up at the top. So, for example, if you have an Amazon stock, and Amazon is trading at $1,000, and it typically trades at $1,000, you get a group of people together, and you say, hey, we're going to run Amazon up. Amazon is going to run up to $1,050 before we sell. So everybody runs Amazon up to $1,050. As soon as it gets to $1,050, they start selling off. Now Amazon closes at around $800 that day because of the mass sell-off, right? So, and then people might even buy back into the company because now they're like, oh, Amazon is severely discounted at 800, whereas it is at least worth 1,000. So that creates a whole nother opportunity due to that chain of events. And a lot of people in the stock market are emotional shoppers, because at the end of the day, you're still consuming in the stock market. Some people are investing for the long term, but some people are consuming in the stock market. So with that being said, if they see that they've lost $200 in a day, they're more likely to sell off because of the emotions. Oh, wow, what's happening with this company? What's really going wrong? And that creates an additional buying opportunity. So instead of it being 800, it's now at 770. And then you can see right away people are eating up Amazon. They're trying to buy more, and raise its value because they see that it's heavily discounted and there's a benefit there for them to buy now rather than wait later. And so all those people who are waiting with cash reserves on the sidelines, they're now going to swoop in and buy Amazon at a heavy discount. So again, that's a whole nother layer of opportunity there when you see something like that happen. And that happens every single year to multiple different companies. And so you have multiple different buying opportunities available to you. I'm not telling you to time the market, but if you do have cash reserves that you're holding on the sidelines, these are the things that you can wait for in order to utilize that. And you want to be watching more than one company, because not every company is going to get pumped and dumped. Not every company is going to go down in value. And then some companies may only continue to go up in value. So what I would suggest, which is just a suggestion and not an opinion that you should hold much weight to, is that you dollar cost average into the market. And then when you see something that is heavily discounted, you would then utilize your resources in order to buy that same heavily discounted asset at that discount rate. So you can make $200 per share on that company without necessarily having to do too much. So let's say you have $10,000 and it's $1,000 company. Instead of buying 10 shares, you're now able to buy 11 shares, right? And then it goes up 200 each. Guess what? You just made $2,200, and it was at its break-even number. So you've turned $10,000 into $2,200. That's a 22% gain in a day or even a week, right? So you can see how profitable it can be to day trade. Now, do I encourage day trading? No. And back when I used to use Robinhood, Robinhood used to limit you to 3 day trades. Afterwards, you was unable to day trade unless you were like a gold member or something like that. So with Robinhood, they would allow you to day trade, and then you would have to wait a week in order to use that one day trade again. And so it was very difficult for you to constantly day trade. Why was this? Well, there's plenty of parameters behind it. Basically, if you're a beginner, which Robinhood caters to beginners, you're basically going to be a newbie, and you're going to be at higher risk to lose a lot of money by day trading. Same thing with options trading. You'll be at a much higher risk of losing money options trading. And so these parameters were set in place for you. However, if you pay, you can bypass those parameters, and now you can do risk-free investing, and you're paying for risk-free investing, which I don't really think is smart. You should actually get those safety guidelines in place for all investors, and you shouldn't have to pay to be less safe in terms of utilizing the options that should have already been readily available to you. So with that, you live and you learn. Robinhood taught me a lot, lost a lot of money, not necessarily day trading, but options trading when I was on that platform. And so you learn a lot, and hopefully this video is going to help others not necessarily make that mistake. You can test out the market, but don't fall victim to the market, if that makes sense. So that's all I have for you today on day trading. Like, comment, and subscribe. Comment down below if you want to hear more, and I'll see you on the next one. Peace.